So we talked before about how in the past currencies had been pegged to commodity prices or fixed to commodity prices, but that today the value of many currencies is determined by money supply and money demand, except for in cases where the country pegs its currency to the value of another currency. That is called a fixed exchange rate, when one currency's exchange rate is fixed to another currency. But like we said before, most countries allow the value of their currency to fluctuate with the market, and we would call that type of an exchange rate system a floating exchange rate. So floating exchange rate is where exchange rates, the rate at which you can change one currency for another, fluctuate freely based on supply and demand for that currency on the foreign exchange markets. So what does a foreign exchange market look like? There are markets where you trade one currency for another. In this market, we've got euros for dollars. And for any market, we could write it one of two ways, right? We could say, what's the market for dollars in terms of euros? Or we could say, what's the market for euros in terms of dollars? And this leads to a little bit of confusion because we can't say that the exchange rate for euros is increasing or decreasing because there's really two different ways to write that exchange rate between euros and dollars. Instead, we use language of currency appreciation and depreciation. And we'll talk a little bit about what that means in a minute, but first let's just understand what's going on in this market. The way that I've written the market is in terms of dollars. Demand for dollars, that would be people who have euros but would like to buy dollars. The supply in this market would be people selling dollars, and those people would therefore be buying euros. So you can start to see how we could write this market two different ways. But in any case, supply and demand for dollars in this market is going to lead to some equilibrium exchange rate for dollars against the euro. We can think about describing both supply and demand in this case in terms of demand, right? So the demand for dollars is people who would like to buy dollars by selling their euros. But the supply of dollars is people who want to buy euros. So we can really just talk about what drives currency demand, and then we can describe both of those equations. So sources of demand for a currency are people who want to buy goods produced in that country. So in this case, demand for dollars is going to be driven by people who want to buy goods produced in the United States. People who want to invest in US companies. So say somebody wants to buy stock in Apple, somebody who lives in China wants to buy stock in Apple. They first have to change yuan for dollars, and then they'll be able to purchase that stock because the US stock will be sold in dollars. And then the third factor here is currency traders who speculate on what exchange rates will be in the future. So if you expect the dollar to become more valuable in another month, you might go and buy up dollars now cheaply because you expect dollars to be valuable in the future, at which point you could sell them. The effect of that really is drive demand for dollars up today, increasing the value of the dollar today based on future expectations about the value of the dollar. This type of trading is going to happen in any kind of market So the value of any asset today reflects all future expectations about the value of that asset in the future.